Hi guys, welcome back to our YouTube channel AlgoWise. So today we have Pratik. So like earlier videos, today me and Pratik we both will be discussing about the bond market in general, the basics of it, the terms, terminologies, and its relation with the equities markets. Mainly, lot of videos have been made about the equity markets. We keep getting a lot of new stuff, new terms, and but not many videos are there in relation to the bond market. So I thought it would be wise to make a video on the bond market. So Pratik, can we start?
Sure,
Yeah,
Kunal.
let's
Thank
start
you.
with the basics first, and then maybe we can discuss the scenario in Japan and every other things also. Yeah.
Yeah. So whenever we talk about bonds, right, we have to understand what exactly is bond. Uh, Bond is some sort of an obligation by somebody to pay somebody. Let's say you are the investor and I am the issuer of the bond. It's just like a loan. Think about it that I am taking a loan. Instead of taking it from one person, I'm taking it from multiple different people, right? So in that case, what happens is that let's say I am the bond issuer. Let's say I am a company, I am issuing the bond, and I am saying that okay, my bond can be subscribed by multiple subscribers. I open it up in terms of subscription, and let's say I make it as a face value of 1,000 rupees, which means that somebody will get 1,000 rupees or whatever coupon they will get on the bond. Coupon means interest rate. Okay, whatever interest they will get on the bond will be
Okay.
based on the 1,000 rupees. So if you are subscribing one unit, you will get one unit of 1,000 rupees multiplied by whatever is the coupon rate, right? So based on that, you will get the bonds,
Okay.
the bond interest, right? And at the end of the term, whenever you are ending the term, at that point of time, you will get it. You will get back the principal. So let's say the principal was 1,000 rupees, you will get back the principal. Now you
Okay.
can. You can purchase 10 bonds, you can purchase 1,000 bonds, you can purchase any number of bonds till the amount I am ready to issue. Let's say I'm issuing a bond which is the total value of the subscription will be 1 crore, so you cannot go beyond 1 crore, right? So
Okay.
that is how the bond subscriptions will work. Now when you think about different areas within the bond market, let me start sharing my screen with you, and let me show you how the bond prices basically move, right? So as I mentioned, the bond can be issued by anybody. Not just about anybody, but it has to be a registered corporation, and there has to be certain technicalities based on which you can issue bonds. Similarly, one of the major bond market in the world is the government bond market, which
Okay.
means that government will issue those bonds and there will be many subscribers. There can be institutions, there can be individuals, there can be pension funds. Anybody can go ahead and subscribe those bonds, right?
Okay.
There is a primary market for the bonds, which means that whenever somebody is issuing the bond, at that point of time, you, I, or somebody else can go and purchase the bond. That is called as primary market. Just like equities, you have IPOs in
IPOs.
equities, right? Yeah, similar to that, you have primary market here. You also have a secondary market, which means that for people who have purchased the bonds, they will go and sell the bonds in those secondary market. They can sell bonds. I can go and purchase bonds from there. So obviously, what will happen is that the price of the bond will keep fluctuating. So let's say I issued the bond at 1,000 rupees. It will not always be at 1,000. It will basically keep changing. It will change from 1,000 to 1,002, or it may change to 1,010.
Mhm.
If the prices of the bond is increasing, that basically means that the effective interest that you will get on the bond will decrease. Why is that so? Because whatever coupon payment you are getting will be based on 1,000 rupees. It will not be based
Okay.
on whatever price you are purchasing, right? So if the
Okay.
bond price increases to 1,100, that means you are still getting coupon at let's say 6% of 1,000. 6% was the coupon rate, so you are getting 6% of 1,000. You are still getting 60 rupees, but you have invested 1,100. That means the interest rates, the effective interest rate on the bond has actually fallen, right?
Oh,
So
okay. So effective interest rate will be based on again the new premium value of the bond, that is 1,010 rupees. And then so based on that, if we are calculating, so that has come down.
yes, exactly.
Mm.
So based on that, you can say that the effective rate of the bond is decided. like at what price you are buying. So at that price, your effective rate is something that you can decide, right? So based on that, see what I'm showing is these are the government bonds of the US: 30-year bond, 10-year note, 5-year note, 2-year note. So as you can see, it is sort of falling. Now, falling bond prices basically means that the bond yields are rising,
Mm-hmm.
because let's say instead of 1,000 you are paying only 900 for purchasing that bond, but you are getting coupon based on 1,000. So obviously your
Mm-hmm.
effective interest rate has gone, right? So
Okay.
your effective interest rate is sort of going up, as you can see. From let's say August. If I want to show you from something like uh, let's say I show you a longer term view, then from 2022 you can see that the bond prices are falling quite substantially, right, in the US. That the same story repeats in India, same story is repeating all over the world, basically. So bond prices are falling means the bond yields or the interest rates are basically rising, right?
Okay.
That will ring a bell, right? Because interest rates globally are sort of rising.
Rising. Mhm.
Yeah, that is why the effective interest rate on the bonds are also rising. So if somebody is issuing a new bond, he will issue at a higher interest rate. Similarly, whatever bonds are already issued in the market, that will also trade at a higher interest rate,
Higher interest
basically.
rate. Okay.
So that is
Mm.
why the bond prices are
Okay.
right. So now I will. This is the very basics of the bond market. Maybe many of our viewers already know this. If not, this will help understand the very basics of the bond market, the prices and the yields that always moves in opposite directions, right?
Mm-hmm.
Now, if you think about something called as uh, currencies, now currencies are also important when you think about the bond market, right?
Okay.
Why do I say currencies are important? The main reason is that uh, the currency market will be dependent on your fiscal policy, monetary policy, the kind of policy that a central bank takes and the government takes of that
Correct.
country, right?
Correct.
So monetary policy is whatever is taken by the central bank of the country, who regulates the currency,
Correct.
and the fiscal policy is
By
driven
the
by the
government.
government.
Yeah.
Yes. So if you think about the currency now, so globally there are multiple different currencies. Every country may have a currency, or Eurozone will have a single currency of Euro. But if you think about the major currencies, like let's say if you think about group of 10 countries, right? They have their major currencies, and those currencies are traded openly in the market. So let's say dollar can be traded against euro, it can be traded against Japanese yen, it can be traded against Swiss franc, right? All of
Mm.
those things are there, right? So those indexes, uh, I mean, there is one specific index called as dollar index. Okay,
Correct.
now dollar index is not determined based on let's say dollar to INR or dollar to Sri Lankan rupee. It's not determined based on that. It is only determined based on six major currencies, right?
Correct.
So
Correct.
if you look at dollar index, it is comprised against the six major currencies, which are euro, Swiss franc, Japanese yen, Canadian dollar, British pound, and Swedish currency, right? Swedish krona. So based on that, you have those the dollar index, which is sort of comprised. Now, why am I talking about dollar index? Because it is one of the major indicators which show which direction the central bank policy of the US moves relative to other major economies. These are all major economies, right? Japan, Eurozone,
Mm.
Swiss, Canada, UK, all these are kind of major economies. So
Mm-hmm.
against those major economies, how does it move? How is it moving? That is sort of very important to understand.
Mm.
Okay, so now if I if I show you the chart, okay. So if I show you this chart, I hope you can see my screen.
Yeah, I'm able to see your screen. Yes.
Okay, so if you look at this dollar index, which
Mm.
is sort of uh,
Yeah, this
Yeah,
one.
so if you look at this dollar index, you can see that dollar generally moves around 100 basically. 100 is where the baseline was when in
Mm-hmm.
1973 or something when this index to came into picture. At that point of time, you had the 100 as the base.
Okay.
Then relatively dollar basically went down for some time up to 1980s, and
Mm.
then it went up very, very substantially up to something like 160, right?
160.
Then again it came down.
Mm.
Yes.
So
So
that was in
uh,
85 or something, 1985. Okay.
yeah,
Mm.
so something around the 84, 85 range.
Mm,
It
mm, mm,
started going up sometime in 80, 81. At that point
mm.
of time, it became pretty substantial growth. So now, if you think about these currencies, right, it basically moves in tandem with the central bank policy. Now, one major event had happened in 1981, which is that uh, the Federal Bank chair who was there at that point of time, Paul, I mean Volcker, basically. So that so yeah, so that person basically stated that we will have to increase the rates pretty substantially, and they started raising the rates pretty substantially, basically,
Okay.
because they wanted to control inflation. They
Mm,
basically took the economy into a recession, a very large recession, basically 1980s and 1982.
mm.
But they started raising the rates quite substantially.
Okay.
So because of the huge rate increases which the US was witnessing, and the other countries relatively were witnessing lesser rate rise. Because of that, there was capital flow into the US. So let's say you have a country which is raising rate pretty substantially, and you expect that the inflation will get under control in that country.
Mm,
Then investors will want to invest in that country's currency because that country is giving more interest rate. Let's say you are keeping a fixed deposit in a bank in that country, you will
mm,
get something around 10% or 15%. And if you are expecting that inflation is going to come down, then that currency is supposed to hold value,
mm,
right?
mm.
If the currency is supposed to hold value, then you will want to invest in that kind of currency, and also you will get higher interest rate in that country. So because
Correct.
of that, what happens is that the currency will strengthen. If you
Mm,
expect, or if investors expect that currency is going to strengthen, or you are going to get very high interest rate with the inflation under control, in that case you will always want to invest in that currency, and you will always want to keep some deposit in bank of that country. So what investors did in 1980s is that people started moving deposits from, let's say, Swiss franc, from euros and other currencies into USD, and they started making the deposits in the bank. So
okay.
based on that, the US dollar started appreciating.
Okay.
Now, I'm giving this huge context to you because this is one of the very important index to watch out even now. Let's not discuss more details into that in this video, but we can
Mm,
definitely discuss about it later.
okay.
And we can always discuss about what is really happening with the US dollar. But right now, if you see,
Mm.
if I come back to current situation,
Huh.
you can see that the US dollar was pretty much in a range. From 2009, it was something like around 80s level. It was trading around that for some point of time. Then it
Mm.
basically went up to 100. It was trading around 90 to 100. At this point of time, you can see it's breaking out of that range. It has
Correct, correct.
broken
Yeah, yeah.
above
It has broken.
105, and
All previous highs, yeah, it has broken.
yes,
Mm.
yes, and it is currently trading around 109 level. So this
Mm.
is probably a substantial thing that is happening. So we'll
Mm.
discuss about it later. But till now, do you think you have some questions that you want to, let's say,
Yeah,
clarify?
see, yeah, so I understood. So earlier also was the dollar index pegged against those six currencies, or was there any revision in between? Because we are discussing a tenure of maybe 30, 40 years, right from beginning, you said, right? So 1971 was the beginning when this index was created and sort of, became an indicator kind of thing. So now, so
Yes,
was it even at the initial
there will
stages?
be revisions.
There will
Yes,
be
there
revision
will be
because
revisions.
euro came recently, right? 2000 sometime euro had come, so
Yeah,
there were
in
revisions made.
1990s we had the euro basically.
Correct,
So
correct. Ha,
before
ha,
that
ha.
we will need to have all those currencies which were
All,
comprising the euro. We may not
okay.
talk about Poland basically, but we'll talk about all different countries
Ha,
which are
ha, ha.
major contributors to
Major yeah,
like
maybe
Germany.
Germany, France, kind of. Okay.
Yes.
So there were
So it
revisions, and
keeps
then yeah.
changing.
Hmm.
Yes, yes. But even after the change, you can see that it's pretty substantial. You can see this chart and you can
Hmm.
try to understand what really happened. Even
Hmm.
if you look at 2000, you can see that it went up quite substantially. It went above 100, it went to
Hmm.
120, and then
Hmm.
again it came down basically. So whenever the economy is doing well,
Hmm.
then dollar tends to come down because people tend to invest in other currencies which are considered little more risky compared to US dollar.
Okay.
But whenever the economy is not doing that well, the
Hmm.
US dollar normally goes up because
Okay.
it's considered like a safe haven investment. People
Hmm.
consider US dollar as very, very safe.
Correct, correct. So now coming to the main point, we started with the bond market and we moved to this currency market. So coming to the conclusion, I just want to know last in last maybe 1 minute or so. So you were saying, so we need to understand the bond market. We need to look at the currencies market too. So what's the inference from the currency market that we again carry forward to our to the bond market?
Okay, so currency market and bond market will be interlinked in the sense, suppose if your bond yields are rising quite substantially, your currency might actually also rise substantially. That
Hmm.
is only if you believe
Hmm.
that the government of the country and the monetary policy making authority of that country, that is central bank,
Hmm.
are in control and they will be able to get inflation under control.
Hmm.
But suppose you have a country like Venezuela, which
Hmm.
has high interest rate,
Hmm.
uh, which has high inflation, and there is no confidence of the investor that inflation will come under control. In that case, the currency will still weaken, even though your interest rates are going up, everything is going up. Even then, the currency will weaken. But in case of stronger economies, which has a very, very long, you know, they have been into existence for a very long time. People generally trust in those countries. There
Hmm.
is a good democratic government in that country. So in
Hmm.
those kind of countries, basically what will happen is that whenever you have higher interest rates and people start believing that inflation will maybe come down, at that point of time, the currencies will strengthen quite substantially.
Hmm. Same is happening currently with US dollar, right? So US
Yes,
ticks check. I mean, it check boxes all the parameters which you told just now. Proper government. Stable government. The central bank under control. The government takes most of the decisions, and even if you see. Rising interest rates, so that's a good thing for investors, right? They'll be getting more money out of whatever they are investing in that particular country.
yes, yes. And also, if you think about Eurozone
Hmm.
also has stable government. Japan also has stable government. You will ask why are those currencies going down? That is mainly because they are not ready to raise interest rates so fast.
Hmm. Hmm.
Federal
Hmm.
Reserve is always talking about raising interest rate very fast. Whenever the market is saying, okay, Federal Reserve will change its policy, then Federal Reserve, somebody from Fed will come and say that, okay, we will not change our policy. We will be very, very hard on the economy. Even if it is hard on the economy, we will raise rates. So
Hmm. Hmm.
they are always tackling inflation. They are basically talking about it all the time. Because of that, what is happening is that US dollar is strengthening in relative terms to, let's say,
Hmm.
Japanese dollar, sorry, Japanese yen or
Yen.
euro.
Yeah. Hmm. Okay. Okay. Okay.
So yeah, I think we can talk about Japan sometime later also.
Sure.
That
Sure.
has
Sure.
a pretty peculiar kind of situation.
Okay. Okay. So I think, yeah, fine. I think we'll make another video and we'll continue this thing itself, this topic itself, the correlation, and we'll take Japanese yen against the US dollar as a comparison.
Sure, sure, Kannan.
Okay. Yeah. Thanks for joining, Pratik. We'll see you in the next video.
Thank you, Kalyan.
Yeah. Bye. Bye for now.